Hi, this is Jim Cunningham, and we are going to cover how to avoid the top 9 most common tax traps. And there's a bonus 10th tax trap to avoid. Great material. I'm doing it with my good friend, Phil Wilson. We're going to cover a lot of things that can really trip people up, and I hope you enjoy. Hi, this is Jim Cunningham. I have my good friend, Phil Wilson, who's a CPA with Markham with me here today. Today, we're going to cover how to avoid the top 9 most common tax traps. And these are traps that we see, Phil, quite often with clients. And, you know, the real question is, have you ever been surprised by a tax penalty? Now, for a lot of people, if your income changes, you might find yourself with a penalty. And that's oftentimes when it first kind of comes up. So if like this is the first year you've made a lot of money, you might find that you have some penalties or not. But are you shocked by a capital gains tax bill? I mean, I think that's the biggest one. We're going to cover a lot of these tax traps and really how to avoid them. But, you know, do you want to talk about capital gains? Like, technically, there is no capital gains tax in California, right, Phil? It's just straight income. And people are surprised by that, aren't they?
They are, because for federal, it's 20% plus the Obamacare tax could you know, with the additional 3% could apply. So it's a fairly low rate compared to 37%. But for California, once your taxable income's over $1 million, it's 13.3%. So that's a lot more than people are used to paying as a percentage of the federal. So it does catch a lot of people by surprise.
Absolutely. Little teaser. We're going to cover next week how to help a child buy a home. Should you give money? How do you deal with title? Do you use wills or trusts? How does that all work? We're going to kind of unpack that because that's a very popular topic for our clients. I'm a partner at Cunningham Legal, over 25 years experience. We have offices throughout California, and I'm a certified specialist in estate planning, trust, and probate law, a real estate broker, securities and insurance license, and a pilot. And this is my good friend, Phil Wilson, who's been a CPA for a very, very long time. He was a revenue agent, and he is the managing partner at Markham's Costa Mesa office in Orange County. So I happen to be in Northern California. Phil's in Southern California, a little bit of Dodgers, Giants, maybe Angels. I don't know. But he has helped in the past resolve tax controversies with the IRS. And Phil and I work together closely with many clients on business owners and high net worth individuals. These are the attorneys in our firm. We've got a new attorney, Diego, who just started. He'll be in one of our Northern California offices. And this is a disclaimer. I'm going to talk about a bunch of stuff. This is not legal advice. So don't watch this and say, I'm going to go and I saw this video that Jim did, and I'm going to go out and do a bunch of stuff and kind of do it yourself. Bad idea. Same thing goes for Phil. This is legal. This is legal and tax information. It's absolutely not advice. So let's start. Tax trap number 1. And I don't know if you see this much, Phil, but many of our clients are actually many of our mutual clients are people who are looking at retiring, right? They're people, maybe they've worked hard their whole life. They're hitting 60. They go, I want to sell my business. If you have an IRA, when you're 72, that's when you have to take a minimum distribution. So the government lets you put away all this money in a 401k in an IRA. And they say at a certain age, you have to take out a specified percentage. And the first year is about 3.65%. You have to take that money out, even if you don't want to take it out. It is a percentage of all of your IRA assets that are aggregated. Now, some of our clients have a $100,000 IRA. Some of our clients have a $10 million IRA. That percentage number, the dollar amount's going to change, right? So on a $10 million IRA, it's almost a $400,000 minimum distribution. But I'm looking at an example here of a $1 million IRA. And the IRS lets you, the very first year, they give you a little bit of a freebie, right, Phil? They let you delay your first RMD to April 1. So the problem, though, is if you take your first RMD like late March, what happens, Phil? You've got the second RMD, right?
That's right, and you have to take that. So it's not really a freebie. By the way, they're allowing you to take a deduction to put money in an IRA or put it in a 401k or a pension plan, but you have to start distributing money at some point, and that comes into ordinary income. So make sure you're aware and look at it, because while you can delay it, it also could increase it, which, depending on what your bracket is or your income level, I mean, it could impact things such as the taxability of your Social Security benefits.
Absolutely right. And that's why I picked this number, because this is a number. If you have kind of a normal, and I'll put that in air quotes, a normal retirement income, this will most likely affect the taxability of your Social Security income and your Medicare Part B. And that Medicare Part B is a 2-year cycle. So it's really important to pay attention to this, because the timing of the money's when you take the money is important. And also, if you remember, the other part of this is they value these accounts December 31 of the prior year. So what's happened since December 31 of 2021? Generally, the market's gone down. If you have stocks, it's gone down. If you have bonds, it's gone down. This is one of those like once every 40-year kind of years, and not in a good way, where it really kind of doesn't matter what you own. It's gone down in value, but you still have to take that minimum distribution by December 31 of this year based on last year's value. So what that means is, if this $1 million has gone down to 800,000, you still have to take that percentage out based on that prior million. So it actually ends up being a larger percentage of your account. So when you look at the numbers, if you start comparing the numbers, you'd be like, well, wait a minute, this is more than my minimum distribution percentage. It may be because your account value's gone down. So you can see our example here is you've got a Hal who waits, and now he has $80,000 in income in 1 year instead of 40 in each year. And again, if he's got kind of an $80,000 a year retirement income, and then you add this other 80, that pushes you into higher tax brackets. It makes you pay higher taxes, frankly, overall. So kind of a bad thing. Again, you need to get advice. So I'm not telling people what to do. I'm not telling you what to do, but just bear in mind that if you wait, it's going to be kind of a 2x in that first year. So Phil, I want you to talk about this, because I see this with legacy clients. So many of our clients, the parents or grandparents or great-grandparents may have done very well, and back in the 40s or 50s or 60s might have bought real estate in a corporation. That's, remember, back in those days, right, there were no LLCs. So LLCs are a more modern creature, but why is it bad to own real estate in a corporation, Phil?
Well, in a corporation, you're going to have a double layer of tax, even in an S corporation. So the rule about corporations is it's very, very easy to get assets into a corporation on a tax-free basis, but it's very difficult to get them out because they have to be distributed out at fair market value. So with a normal C corporation that doesn't flow through, but it pays its own tax, if you sell a piece of real estate, you're going to have taxable income inside that corporation, and then you're going to have another tax, a dividend, when it's distributed out to you. So the tax can be very expensive. Whereas in a partnership, with an LLC is taxed as a partnership, you have one level of tax. In California, you may have an LLC fee, a gross receipts fee, but it's nowhere near what it would be for a corporation. So while we do have clients that we've gotten, and they still have real estate inside of a C corporation, we just make certain that the clients are aware of that, they know what's going on there. But for properties, when they're purchasing them now, we would always have them inside of an LLC or a partnership, a limited partnership.
And by the way, we've covered this in other webinars. An LLC is a limited liability company. It is it's the most flexible vehicle for running a business or owning business assets, not personal use assets, but business assets. So an LLC can have one person, and it can have more than one person. It can be taxed as a partnership. It can be taxed as a corporation. It can be taxed as what is called a disregarded entity, which means you don't file a federal return like you would file a federal partnership return or a federal corporate return. You do file a state return, at least in California, and that all those, there's no tax on the LLC level. So it's almost like a disregarded entity is essentially like a partnership, lowercase p of one, right? So it looks like more like it's taxed like a partnership. Another very important issue is when a person passes away, we're in a community property state, California, and we'll talk about community property states in a couple of slides. When one spouse dies, all community property gets a step up in basis. So that means if you bought a rental for $100,000, it's now worth $1 million and you've depreciated it, right? And your spouse dies, if the two of you own that as community property, that gets a step up in basis, except that does not apply to corporations. It does apply to partnerships, and that's called the 754 election, which is an election you make on a partnership return. But it's very important to understand You do not get an adjusted basis on the underlying property within a corporation. Now, you may be asking yourself, I inherited a farm, land from grandpa in a C Corp. What do I do about that? The answer may be what you said, Phil, is not much. If you continue to farm that land, I mean, maybe, and there are other reasons, by the way, there are other Prop 13 reasons why you might want to keep a legacy entity, but also understand that there used to not be any S Corps. So, you know, if you formed a corporation in the 1950s, there was no S Corp, which is the pass-through tax treatment. They were all C Corp. So very important to understand, what's this 1.5% tax on an S Corp? What, can you explain that?
So California imposes a tax at the corporate level on an S corporation. So it's 1.5% of whatever the net income is of the partnership. And it doesn't matter where the income comes from, that's assessed on the net income. So, you know, if you have a large gain, you're paying, right, $15,000 per million.
Mm-hmm.
So if you have a $10 million gain, you're saying, okay, well, it's going to flow through. That's fine. Yes, except you also have the 1.5%. So the key
in
with this,
addition
Jim,
to state income tax, federal capital gains tax, right?
at the individual level,
Yeah,
right? And so the key is make sure that you know what's happening before you do something and trigger a gain. And there may not be a lot of ways to plan around that inside that entity, but at least you're going to know and you're going to be prepared.
Yeah, and there are some tax deferral strategies, but that, unfortunately, that 1.5%, you can think of it as a sales tax, and there's really not much you can do about that. All right, so fumbling an inherited IRA or an IRA rollover from a 401k. This is very important. We do have a question, and I'm assuming it's about the corporation, so we'll do you recommend doing a conversion from a C Corp to a new LLC? Kelly asks. I mean,
it depends on the facts and circumstances.
Right.
The best thing you could do is have a professional look at it, talk with your CPA, and you know, they should be able to advise you and run a scenario and let you know what it means to you. And everyone's tax situation is unique.
Mm-hmm.
Everyone's company is unique, depending on what state it's in, et cetera. So that's something that, you know, you just have to look at each individual circumstance.
Yeah, so it may make sense, it may not. Again, it's really hinges on its facts. So when you leave a company, so a 401, you want to explain what a 401k is? I mean, pretty much everyone knows, but Phil, tee this up. What is a 401k?
Sure. So it's a retirement plan that's available, and there's a limit that you can put into it every year, but you're taking a deduction off of your W-2. So you're getting wages, or you could have an active trader business, you know, a partnership, an LLC, and you're able to defer money into a pension plan, a 401k that's an employer plan. And there may or may not be matching, but you're allowed to take a deduction from your income, so it'll reduce down the W-2 that you have, which is great, except that ordinary deduction, it grows tax deferred, not tax free, but it grows tax deferred until you're required to take the money out, or after you're 59.5, you can take it out without a penalty. 10% for federal, and then various states have their own penalties. But at some point, you or your estate is going to have to pay the income tax on that deferred gain.
So what we're talking about here is you're working at a company with the 401k, and you leave that company, and something that you should be aware of, companies in many circumstances can borrow against the 401k, which is kind of scary, meaning that's your retirement money. A lot of people don't like the investment options that they don't have with the company plan. Oftentimes these company plans are more expensive than the ongoing care and feeding of a regular IRA if you were to roll over the IRA. So what we're talking about here is, you know, you're working for a company, you separate from the company, you get another job, maybe you retire. And then what you do is you say, I'm going to roll that 401k over. Now, this is very important. I'm going to roll that 401k over into my own IRA, my own individual retirement account. So you got $1 million in a 401k at a company, and you separate from the company. There are two ways of getting the money. They will either write a check, okay, or they will do what is called the trustee to trustee transfer, or direct transfer. I would really counsel you, or recommend, I should say, just plant this idea in your head. Getting a check is very dangerous because you have 60 days, 60 days to get that into an IRA. And I'm telling you, 60 days goes by in about 5 seconds, okay? It is not uncommon for people, if they get a check, that they don't make that 60-day deadline. Well, I don't know who I'm going to invest it with. You know, the market's down. I don't want to do this. I'm going on vacation, whatever, right? Do
Right. The
consider
safest, safest
the
way.
trustee to trustee transfers. So this is where you go out and you go get
That's
a,
right.
Ascent Wealth Management has been on our webinars a lot. Let's say you open an IRA with them. And what they'll do is they'll contact your employer, and that'll happen in the background. And so you never take physical custody of that check. So this is the electronic funds transfer that we're talking about here. So
Right.
I will tell you, the check thing does not work with an inherited IRA ever. There's no 60-day rule. If you get that check, if you inherit an IRA and you get a check, that is fully taxable to you the moment you get that money. So that's really important, that direct trustee to trustee transfer. So we see people screw this up, and people, it's one of those like, I can't believe I screwed up and I'm losing half my IRA. Okay. Because that's what the tax is in California, state and federal. Okay. Leaving California. Now a lot of people leave California. A lot of people move to California. 40% of Californians were not born in the United States, which is, just get your head around that. That's it's 16 million people. We're not born in the United States. So there are a lot of people coming to California, a lot of people going. Here's something to understand about community property. Community property is in Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin. Those are the community property states. If you are a resident of one of those states and you are married, all of your community property gets what is called an adjusted cost basis at death. So again, that example I gave, if you buy a condo for $1 million or 100,000 and it goes up to $1 million and your spouse dies, you can sell that $1 million condo for $1 million and not pay capital gains tax. That's a pretty good deal. All right. I would say this is probably one of the single biggest benefits besides weather and culture. Okay. But besides the beauty of California, this is one of the single greatest benefits of living in California. So California is a great place to die. Other states aren't as great to die. Chicago is probably, you're going to probably pay the most tax in Chicago or New York. Okay. You're not getting an adjusted cost basis. So, and if you have partnership assets, your share of your partnership assets also gets an adjusted cost basis. So very, very important. Now, what's a residence memorandum, Phil? If you can kind of talk about that. I know your firm does these. So let's say somebody lives in New York and California and France, and they're dividing their time. And they're like, wait a minute, am I a California resident or not? Can help me with this residence memorandum.
So oftentimes we have a state and local tax group that actually does residency memos when clients leave a high tax state and go to a no tax or a lower tax state. For example, Arizona has a 2.5% flat tax. Florida, Tennessee, Wyoming, Washington State, Nevada, no state income tax. So if someone's leaving New York, New Jersey, California, and moving to one of those states, what we do is we have the clients do a memorandum to protect themselves so that if that state comes calling with a residency audit 2 years from now, we document when they've left, the fact that they've left, all the facts in the favor of why they're no longer a California resident, what they're doing, they're spending their money, they're having their pets groomed somewhere else, they're getting their personal services done in another state, and that they're truly out of that state. Because California, New York, New Jersey are extremely aggressive. They want the tax dollars. And so if you're going to be out of California, make sure you're actually out of California. And a memorandum is a great roadmap to make sure that you really are out and that we've got something tangible. Because 2-3 years down the road, when you're being audited, it's very difficult to go back and try and figure it all out.
3 years ago, by the way, we're in November of 2022. I want you to think about what you were doing in November of 2019. Now we've gone through COVID. So most people are like, that was like 100 years ago. Do you know what I mean? So and what happens is there's a delay, right? So you leave California in a given year, they're not going to come calling for their money for a few years, right? And so then you've got to go back in time and figure out, when did we leave? Where was my gas? Where was I buying gas for my car or whatever it is? So very important. If you're going to leave California and you're worried that they might tax you, I would really reach out to Phil, consider a residence memorandum. It might make sense. I would say that if you're moving to another community property state, from a community property state. Many of our clients moved to Texas. My parents moved to Texas about 3 years ago. You really should have your estate plan reviewed. Now, we do have Daniel Van Slyke in our office who is licensed in Texas. Texas community property laws are different. Okay, there's a lot of stuff that's different about Texas, and also includes their community property laws. The other thing is, if you're moving to California, it's very important that you have your estate plan updated for a variety of reasons. We have property tax issues. We've got this adjusted cost basis. You do not want to miss out on these significant tax benefits. And frankly, you can if you don't pay attention to the details. And frankly, a lot of this, Phil, this is not, it's not make work. It's a lot of it's documentation, and a lot of it is it's like turning a screw a quarter turn. You're not doing much, but you're doing enough to pick up the tax benefits. So it's very important to assemble a team.
And another thing to really remember is every state is unique, and when you do legal work, unlike doing your income taxes, yes, the states have some different rules in all the different states. But when it comes to legal work, it's really state specific. And in fact, California has a great asset protection program with the private retirement trust. So Jim, I know that's something that your firm does.
Right.
And it's a great way to have asset protection that's unique to California residents.
Yeah, and that's only available for California residents, right? That's, the California Private Retirement Trust, California Private Retirement Plan. That's a whole process, okay? But it's something that we need clients, especially business owners. If you're a business owner and concerned about liability, it's a great way to be able to kind of sleep, sleep a full night.
And many business owners say that, even above and beyond estate planning, they say that minimizing risk and reducing the fact that they're a target for lawsuits is extremely important to them, because they've worked hard their entire careers to build their companies and build their net worth. What can they do to protect it? So again, I know that Cunningham Legal does a lot of that type of work. Reach out to Jim and he'd be glad to have a discussion.
Thanks for the plug, Phil. All right. Failing to consider a Roth conversion. Here's what I'm not talking about. I'm not talking about giving $6,000 and putting $6,000 a year into a Roth. What's the income cap on that? Like 160, something like that, Phil? I think something around there, right?
Yeah, it's fairly low because a lot of people have a lot higher income than that, and they aren't able to do it. However, there are ways to reduce your income in a single year. Maybe you can trigger some losses. Maybe income's down 1 year. But I think what you're speaking about, Jim, is how can we actually do a conversion of all of our IRA, or a significant portion of it? You can plan it to convert that, pay the income tax now. For example, the markets are down, right? They're down, what, 20%, 25% off the high? You can actually do a conversion at that lower rate, pay the tax now, and we know that it's going to go up over the next 10 years or 20 years. Really, and so that money will grow tax-free. You've paid the tax. So as we said earlier, remember, that's going to come back in as ordinary income at some point when you take the distributions. Now what you're doing is converting using other money. You can't use the money on the conversion because that needs to be rolled into a Roth.
Yeah, so this is really, really important. So markets are down. You may have lost money, okay? If maybe you bought some stock and that's down, this is why you need to assemble your team. Typically, this is going to be the CPA and financial advisor, to a lesser extent, the lawyer, but the lawyer's involvement is, I would say, the least involvement. But this is really the lawyer's job, in my view, is to basically help the client shepherd the transaction through. And this is where your CPA and your financial advisor need to talk to each other, because I will tell you, there is a natural reluctance. And if you're a financial advisor watching this, I think you know what I'm going to tell you. There's a natural reluctance to recommend a Roth conversion, because the view is, well, if I do a Roth conversion, somehow there'll be less assets under management, and my fees as a financial advisor are based on assets under management. That is not always the case, because there are things that we can do to find tax savings, right? If some of your stocks have come down in value, maybe that could offset some of your Roth conversion. So there are a lot of things that are out there. I think it takes a holistic view. And this is why it's really important for the CPA and the financial advisor to work together, because, you may have some losses in there that you can use to offset some tax losses, right? To use to offset the Roth conversion. So very important to take a broad view and not just listen to one advisor. And I'll tell you, Phil, because you and I work together in cases like this. A lot of times the client's in charge of the project, right? It's like being your own general contractor. that's a really bad idea because most clients don't know this stuff. You know your life and you know what you know. And for a lot of people, they just don't have confidence in this area. That is why it makes sense to work with, frankly, our firm, because we understand a lot of this stuff because we're doing this day in and day out. And so when we sit down with a client, we look and we say, if you do this, this, and this, you can effectuate a Roth conversion with little or no tax. And the financial advisor who's reluctant to recommend it gets behind it and goes, oh, I didn't know you could do that. And so really, I think this is something to look at, especially in this year where the markets are down. I did put in here solar and oil and gas. Oil and gas ship has sailed. That comes around next spring. The solar is, we're in the twilight hours of the month. I think, our kind of internal mental cutoff is December 1 for looking at solar projects. So we got about another 30 days this year. But there are things that you can do to offset that by deploying capital in a different way. And you can offset 500,000 of income. So if you did a Roth conversion of 500, you could maybe look at solar and oil and gas to offset that 500,000 taxable gain. And this is on non-business income. So if I got that right, is that correct, Phil?
Well, the solar is actually against business income. So It works really, really well for shareholders that have an S corporation or a partnership LLC, or they own real estate. But this is the world we live in. This is the planning we do every day. And so make sure you're using a professional who knows this area, does a lot of planning, because we've done it over and over and over. And so we're able to advise and help in those areas, meaning us as the CPA community.
Yeah. And I'll say we have a lot of clients in their 60s. A lot of times people have quit working when they're hit 60. They don't have minimum distributions. You may not have a lot of earned income in your 60s, right? Because you're delaying taking Social Security. You may be living off savings or other type of investments. And look, Wanda, age 60, she converts 100,000 of her million. She's not doing the full million. She does 100,000 of her million to a Roth while the market's down and purchases a solar project with other money that gives her a $40,000 tax benefit. That zeroes out the income tax liability for her conversion to a Roth. So you can do a Roth conversion and not pay taxes, where I'm going with this on a very high level. Mm-hmm. So I would say another tax, this is really a trap, making a cash gift to charity. Now, you may say to yourself, Jim, I support charity and I just want to write a check. Maybe you go to church and you're tithing at church. Maybe you support social causes. Maybe you support the nature, or you support the homeless, or whatever it is that you support. Giving cash to charity might not be the best approach. And there are two big alternative methods of giving. The first one I'm going to talk about is a gift of appreciated stock. Let's say you own 100 shares of Apple. You can give those shares of Apple to a charity. They then sell those shares. And because they're a charity, Phil, how much tax do they pay?
Zero. Well, they pay none.
Yeah, none. Then you go out and you buy those 100 shares of Apple in the open market. You're not going to be subject to the wash sale rules, which means by doing it this way, you get a new basis on your Apple stock. So when you sell that Apple stock in the future, you pay less capital gains tax. And that's where I'm going with that. This is a way to increase, it's like a freebie to increase your tax, the tax base on your stock. What I mean by cost basis, if you buy something for $1 and you sell it for $3, you got to pay tax on the $2 gain. Well, in this case, if you bought Apple for $1 and it's worth whatever it is, and you give that away, the charity gets all that gain tax-free. So you could have given the charity cash, but instead you give them your old low basis Apple shares and you go out and you buy new Apple shares. This is just basic. I would chalk this up, Phil, as basic tax hygiene. I don't know. Do you want to walk?
Yes, and yeah, right. And so the thing to remember is you're not just using post-tax dollars to then make that deduction.
Right.
That gain on that stock is never going to be taxed to you. So you're giving away something instead of selling the stock. The alternative would be sell the stock and donate the cash. Well, why would you do that? Because then you have gain. If you just gift that stock, the appreciated value of the stock, and it's worth $100, but you paid $5 for it, your charitable contribution deduction is $100. So that's a simplified version. We can run scenarios. Your CPAs can run scenarios to show you how that works.
Now, there are some caps on this in terms of deductibility, but the point is, this is just a basic strategy that a lot of, I would say, people who understand the nuances of this do. And if you don't pay attention to it, I think you're just leaving money on the table. Qualified charitable distribution is where you, instead of your required minimum distribution from your IRA, you send it directly to a charity. So let's say you want to support a natural, the environment, maybe the Sierra Club, right? Instead of taking $100,000 minimum distribution from your IRA, you send that $100,000 to the Sierra Club. Now, why is that better, Phil? Why is that better to do it that way than take the money and then turn around and make the charitable deduction?
Well, again, I mean, it's just what you're trying to do is you're trying to avoid your overall tax and maximize your deduction. So again, there's many different ways you can do this. I mean, Jim, there's also the trusts that you can do. So, these are not things that you would do on your own, although you could do it with the appreciated stock. But it's always best to run scenarios, use a professional, work in conjunction with your CPA and your financial advisor. That way you're going to be able to maximize your deductions and reduce your tax. Everything that we're trying to do is try and reduce down the income tax to the lowest legal amount that you're able to pay.
Yeah, and the problem with taking your minimum distribution, your $100,000 minimum distribution, and then giving it boosts your overall income, which means your Social Security's taxed higher. It means your Medicare Part B contribution is bigger. And again, to your point, Phil, it may matter, it may not matter. We don't know. But for many of our clients,
right,
they do the qualified charitable distribution because when you run the numbers, when you run the scenario, you have more money at the end of the day than if you had taken the distribution from your IRA. I was just going to say, Jim, it's very interesting because everybody thinks that once they retire, their income is going to be a lot lower. And so that's why they're deducting the IRAs, deducting the 401ks, but oftentimes they've been good savers. They've got a lot of income and the income's not lower than it is when they were working. Absolutely. I mean, I can't tell you how many people they tell me I'm making more money in retirement than I ever made working. That is not uncommon. Okay, so annuities. I am going to talk about some people, when they hear the word annuity, they go, I don't have an annuity. I'm going to shut my brain off. You really need to pay attention to this because this might be your annuity. This might be an annuity that you're inheriting, and you might be an advisor and not know this rule. So this is another thing. Frequently, annuities will offer 2 and sometimes 3 distribution options at death. One is a lump sum. The second is distribution within 5 years or a stretch payout over your lifetime. Now, this is something very important to understand. An annuity fundamentally is a contract. It's a contract between the annuitant, the person who has the money, and the life insurance company. Okay, typically it's a life insurance company, the insurance company who takes the annuitant's, typically the annuitant's money. And they will take that money and there will be some type of measurement, some metric to determine your return on that money. Now it can be a fixed percentage, 2, 3, 4% a year. It can be tied to the S&P 500, and you might have it be 75% of the S&P 500 up to a 10% return with no downside. And so there's these complex math formulas, but this is something very important to understand. When you give that money to the insurance company, that is treated, that whole transaction, any gain you get from your annuity when you die is going to be taxed as income. Okay. So it's going to be taxed at the higher rate. So it's not invested. When you give that money to the insurance company, they're not putting it in the S&P 500, even though they're giving you a return based on the S&P 500. They're typically doing something else with that money. So it's very important to understand that you are giving money to an insurance company and they are paying you back based on some contract rate. So this is purely a contract. Now, if you put in 100,000 and the annuity goes up to 10 million and you leave that to your living trust, you're going to have $900,000 in gain that comes out right away. All right. That is really, and that's 900,000 in income. That's a really bad result. Okay. Because you're going to be paying $450 in California. You're going to be paying $450 in income tax. It is much better to stretch it out over a longer period of time. When a spouse is named as beneficiary, generally the spouse steps into the shoes of the annuitant spouse who's passed away. Okay. So if you take out an annuity, then pass away, and you leave your spouse as the beneficiary, typically that spouse becomes the owner with no distributions. But when it's a trust, even if there's a spouse as beneficiary, this can create a really big problem And so if you have an annuity, you need to look at the beneficiary designation, right? And I would suggest you reach out to your annuity company and say, hey, if I die, who gets this money? And if it's your living trust, you may have a higher tax, or your estate may have a higher tax bill. Okay. And this is a tax trap. All right. Your estate may have a higher tax bill than if you leave it to an individual person. Okay. So this is a very nuanced type of issue here, but you do need to pay attention to who the beneficiary is. And I will tell you, lawyers typically counsel clients on beneficiary designations when clients do estate planning. The CPA is not in the room. The financial advisor is not in the room. Typically, it's a lawyer and the accountant. And I'm going to tell you a secret. Lawyers don't know any of this stuff. Okay. We are not trained on annuity taxation. So
well,
you need to pay attention.
Jim, but they typically think, hey, you know what? We're going to leave it to the living trust. That way we avoid probate. That may not always be appropriate. So make sure you involve your team.
Yeah. And this is definitely a team approach. And by the way, there are other products that let you, in that example where it was 100,000 and 900, there are other products out there that let you take that first 100 out tax-free and then take that 900 out over your lifetime and stretch out those payments over a lifetime. And the reason you would want to do that is you're typically paying tax at a lower bracket. You're paying less tax overall. So, and again, this is just modeling out, but there is an exception. If your spouse is beneficiary of the trust, if the insurance company treats the trust as agent for the spouse, you're okay. But again, this requires extra work. This requires a workaround. This is legal fees, accounting fees. It's like 10x, literally 10x the work to figure this out after somebody passes away. So naming a trust is not always what you should be doing with every asset, including an annuity. What about late? So if you're in California watching this, you're going to go, are you kidding me? So,
well, California,
listen,
California
I want you to cover this
has
one.
done this, Jim. Right.
Yeah.
No, California did this because, you can think of it as maybe budget shenanigans, but what they're trying to do to get their budget under control and match the revenues coming in is they're front loading the amount of estimated tax payments that you need to make. So you're paying tax where you look at that bullet point number 4, where it says you have to put in 65% by June. Well, wait a minute. If I have to pay that by June 15th, which is 5.5 months into a 12-month year, I'm actually paying tax to California before I've earned it. Yes, that's correct. So again, oftentimes we'll do quarterly tax planning, or if it's someone whose income is going to be similar year over year, we'll issue estimated tax payments to them in the first quarter so that they get that amount in there for federal or for California, unlike federal, where you can safe harbor based on your income from the prior year. When your income reaches $1 million or more, you are not able to safe harbor that. Now, if you have a large capital gain later in the year, it's taxable in that quarter. Because if you have a gain and you're selling your business, or you're having a very large capital gain in the fourth quarter, you can't pay the tax early because you haven't realized that gain yet. I'm talking about just income as a whole from your normal income.
Well, let's say I sell a business for $1 million on September 30th. California business, I sell it September 30th. When is my quarterly payment due?
That would be due October 15th.
So I have 15
because
days.
Because the quarter ends September 30th. That's the end of the third quarter, and you have to pay it. But you'll also have the cash because you recognize that gain.
Well, you hope you have the cash, but it depends on how the deal's structured, right? I mean, you don't want them closing September 30th and we'll pay you October 31 or something. I mean, then you're kind of stuck. So, Phil,
typically most individuals are cash basis, and so if you're receiving the cash in November, then it's a fourth quarter, and it will be due January 15th. But again, that's why it's important that you're aware of this, and you think, you know what? I remember seeing something about that. I better call my CPA and see what's going on here.
Yeah, and this is like something CPAs know, right? Tax preparers know this.
Yes,
rule. Okay,
of course.
So what if I don't pay my taxes on time? What if I go, I'm not the kind of person who pays, which is not me. I'm not the kind of person who pays quarterlies. I'll just wait till I go into my CPA and on on April 15th at 11:59 p.m. I'll write a check and stick it in the mail. What are the penalties
Well,
if you don't pay on time?
it's an underpayment penalty, and think of it as an interest charge, a non-deductible interest. And you know what? Depending on who you are and what your situation is, there are people that do that. There's business owners that do that.
Mhm.
And, of course, we prefer that they not do that and that they pay their tax, because the government requires that you pay your tax as you go throughout the year. But, unless there's an exception, such as for federal, where you can rely on the prior year, then that money is not due on any excess until April 15th of the following year for individuals. And same thing, if your income for California is 700,000 of taxable income, and the prior year it was only 100,000, that excess isn't due until the following year. But it's always a good idea to run a scenario, run the projections, and see what it means. And even if it is due the April 15th of the following year, our clients like to know what's coming. Where am I today? I'm sitting here on November 3rd. And what does it mean for, what do I need to pay by January 15th? Or what do I need to withhold in December? And then what's due April 15th? They don't like surprises. They like to know what's coming so they can plan their cash flows.
Yeah, and I think the big takeaway from this is federal is an annual cycle. State is quarterly. So just think of that. That's how I keep it straight in my head. Is if state of California, you're quarter by quarter by quarter. Federal is annually.
Well, as long as your income is going up substantially, but you still need to, based on the prior year, you still can safe harbor for federal, but you need to pay them quarterly or have it done through withholding.
Anonymous asks, I had a late payment of estimated California income tax with only a fee of $12. Income was 700,000, was annoyed, but not hit hard. Well, great.
That's good. And for $12, I would probably urge you to go ahead and just pay it and not send it to your CPA.
Yeah.
It's not worth looking at. It's too small of a dollar amount. Now, does that mean that it's computed correctly? Who knows? Maybe it is, maybe it isn't. You'd be surprised how many penalties people just pay and never look at, and they don't understand.
Well, I got to tell you, Phil, I think most people don't understand their income tax return. They're like, okay.
Right.
Now, the innocent spouse trap. Now, I hope none of you are in this situation, but there is a reason why I'm mentioning this, because I want to highlight the difference between married filing separately and married filing jointly. If your spouse is up to no good, something you need to understand is when you are married filing jointly, you are jointly and severally liable, meaning you're equally responsible. So if you think like,
no, not equally, Jim. It actually means that if I'm married and my wife has a liability that I'm not even aware of for whatever reason, or it gets assessed later, they jointly and severally means they'll come after you jointly. But if I have the cash, they're going to take it from me. Yep. They don't care where they get it from. And
something to understand is both, I would put the state of California and the federal government in super creditor status, meaning it's hard to function in society with a federal or state tax lien. It makes things functionally extremely difficult. Okay. So you don't want to go there. Married filing separately has some disadvantages. Do you want to talk about what the disadvantages are, Phil?
Right. So a lot of your tax attributes, such as, the amount of capital gain, you can deduct up to $3,000 in excess of your gains as losses, but that's cut in half to $1,500. You limit your IRA contribution. There's a lot of limits that are placed because they kind of separate what it would be if you're married filing joint. And even if you're single, it would be less. But if you're married, you're either married joint or you're married separate. So, that's something where, we've had situations where we'll run the tax returns both ways, determine what it is. But remember, you always want to look at it, because innocent spouse is important. It's very, very difficult for the IRS to make a determination that you are an innocent spouse. It happens. Most often it happens when you have an illegal source of income. Spouse doesn't know anything about it. However, if you're enjoying a lifestyle and there's only 50,000 reported on the tax return, but you're living on an income that's $1 million, $2 million, you should have known. And the IRS is going to say, wait a minute, you're enjoying that lifestyle. You should have known. A reasonable person would have known. So again, be cautious. There are times when it does make sense to file separate.
A lot of people get married. Maybe it's not their first marriage. Maybe they get married later in life. I'm not sure. Well, I know when I got married, I didn't ask my wife, do you have a previous tax liability? Right.
You did.
So if you're going to get married,
you weren't an attorney then, were you, Jim?
No, I was in law school. But so this is something that you may not know what happened in the past, right? Let's say you meet the new love of your life and you want to get married, and then you just I knee-jerk married filing jointly. I'm not sure that's such a good idea, but if your spouse has a previous tax liability, if you file jointly, your refund doesn't get applied to the balance owed. And then what's an income-based debt repayment plan?
Well, that's if you have to go into an installment agreement with the IRS or you're doing an offer in compromise. It's going to complicate things. I mean, generally, when we get a couple that's newly married, we'll get, most likely we've been doing tax returns for either husband or wife, and then we'll get the prior 2-3 years of tax returns, and we're able to tell right there, are they paying their tax? What are they doing? We ask those types of questions.
Yeah, so this is really interesting. So there's a saying in the law that the fact of marriage changes an estate plan. The fact of marriage changes your tax status. So it changes in ways that you can't control. So would you have any recommendation or any thoughts for somebody? Let's say you've got two people in their 50s, they decide to get married. I mean, it's kind of an uncomfortable conversation to say, hey, can I see your last 2 years tax returns? But it's probably not a bad idea, is it?
So Jim, there's a big difference between getting married in your 50s. I mean, Jim, you and I, we're both in our 50s.
Yeah.
But I got married when I was 24 and you were fairly young also.
Yeah.
So when you're in law school or you're just starting out, you're probably fine. You don't need to worry about these issues. When you've got assets and you may have children from a prior marriage and you've got a lot of complicating issues, you really need to do marital planning. You may want to do a prenup. Look at Tom Brady and Giselle.
Yeah.
They just got divorced. It was just finalized. They had an ironclad prenuptial agreement. In this case, her assets were significantly more than his. She has a lot of other sources of income just besides modeling. And so, it is important to look at those issues and plan for that.
Something if you're in the process of divorcing, why would you want to file separately? What's the reason behind that, Phil?
Well, if you're in the process of divorcing and you've actually separated your property and you live separately, you may not be married separate. You may actually be filing as single. It just depends. Okay. Or you're filing married separate. Usually you look at the final day of the year, December 31st. Are you married on December 31st or are you separate? And then also with respect to the income that you're receiving, if you're actually moved out, then, your income is yours, the other spouse's income is theirs. And so it's a very complicating situation. Divorce attorneys don't always understand those issues. They may understand them, but, again, involve your tax advisor, involve your tax attorney. There's a lot of complicating issues there. And the larger the dollar items are, the more likely you are to get your other professionals involved.
Now we have a bonus trap or avoiding a trap. And this is just in general,
okay,
leaving money on the table. And I think you've talked about getting a good qualified tax preparer, getting an A-team. And if you're a W-2er with home mortgage deduction, maybe you go to a national change, maybe do national chain or TurboTax. But what's a number? Can you just give me a number? What is a big number? When you start making this amount of income, when should you really not do the TurboTax and not do the national chain people? But by national chain, it's like the Liberty tax and the H&R Block is what I'm talking about.
Right. So I don't know that there's a magic number, Jim. I think you also have to look at assets, because if you look at real estate developers, they get a lot of depreciation. Their income can be fairly low, yet they have a lot of complicating issues with, all of their assets. So it's not just an income issue, but from what we see, anytime you have business owners that are netting more than $1 million a year, it probably makes sense to have a good firm because you've got issues. You have an extra 3 zeros on the end. And so everything becomes more meaningful. The penalties are more meaningful. The ability to plan is more meaningful. That's not to say that, we don't have clients that have had net operating losses in 1 year. They might. Maybe you've got something where your income, you had a large loss here, but you have huge income over here in a different year. It really just depends on your income situation and how complicated your asset situation is, and if you own a business.
Yeah, and I like to say, if you're not claiming every credit you qualify for and not taking every deduction, or every income adjustment, you're leaving money on the table. Something I've heard clients say in the past is they might have rental property and they say, I'm not taking depreciation on my rental property. Well, if you don't take it, it's still getting depreciated because those are the rules. I mean, you're not opting out of that. You might as well take it, right?
That's right. It's depreciation taken or that should have been taken.
That's
so
right.
The basis is lowering even if you're not taking your depreciation.
It's happening on its own. So, so when you have a major change in income, I think it makes sense to hire a tax professional. We get a lot of these calls from clients. They say, Jim, I've been making $100 grand a year. I'm making 3 million a year now. I'm doing software development, whatever it is. And when that number changes, I will tell you that is a very painful year because not only do you have to come up with a lot of money, but now you have to start paying quarterly. So you get that double whammy. And you want to talk about refunds and what a refund really is. A refund is not a good thing, is it?
Well, if it's a small refund and that makes people happy, that's fine. But what we're talking about is, if you're getting back $50,000 a year, and I'm talking about a refund where it comes back into your bank account. I'm not talking about the fact that you're filing in October and you have $100,000 that's being applied to your estimates, because really all that is paying in your first quarter estimate and your second quarter estimate. That's different. We're talking about money that's withheld coming back to you and just coming back into your bank account every year. Some people do it, especially W-2 wage earners that don't earn a great deal of money. They do that. They get back refunds, but materially they're not that much. But if you're getting large refunds every year, you really are just making an interest-free loan to the government. Because if the shoe was on the other foot and you were owing a large amount every year in April, guess what? You're going to pay some underpayment penalties because you're not paying it in ratably throughout the year.
That's right. And so it's just an interest-free loan to the government. I don't know anyone who would want to do that. If you have any questions, go ahead and put them in the Q&A. Our offices are located in Northern and Southern California. And if you're watching this on YouTube, subscribe to our YouTube channel. It's a great way to stay current with all of our webinars that get pushed out on YouTube. And if you like what you're seeing here, please review us on Google. And we do have our next webinar, which I got to tell you, a lot of people ask, how do I help my kid buy a home? Right? Do I give them the money? Do I set up a trust? Do I do it in my will? What's the best way to do that? Well, we're going to kind of look in all the different ways. It's really an opportunity to look for free on all these different planning strategies that many people pay for a consult to meet with us. So if you have any questions, you can reach out to me. You can reach Phil at marcum.com, marcum.com. And when you call, if you call us, that number 866-988-3956, you're going to talk to a client specialist. A lawyer's not answering the phone. This is not the FBI. You're not going to get an agent. And let us know if you want to update or create an estate plan, or if someone has passed away, because there's kind of a fork in the road. So if someone has stopped being trustee, that's a different path than if you want to minimize your income taxes and set up your estate plan. And please tell us your goals. Don't ask for pricing. Only lawyers can quote fees, and you're not talking to a lawyer. And really, the legal advice, that's not the time for the legal advice. But the goal of the call is to arrange a mutually convenient time to speak with a lawyer. And so they can go over, depending on what you're looking for, they can go over the process. But we're here to help you. So we have 2 questions.
Jim,
yeah.
I was gonna add one thing. So our website is marcumllp.com, MARCUM That'll take you to the website. I run our Costa Mesa office. You can click on that, send me an email, or Cunningham Legal. If you follow up with them, they'd be glad to put you in touch with us. And Jim, I'm really curious to know how to help the child buy a house, but I guess I just have to wait one more week.
You do. Sorry.
All right. Okay.
All right.
I'll tune in.
So Anonymous asks, my wife filed married filing separately, and my CPA said that I thus couldn't use deductions on my return. Does that sound right?
Yes, that's very possible, especially if this is your first year and you just got married. And let's say she has capital gains that are flowing through. Those stay with her on her married separate, not yours, because they were never yours to begin with. So it is possible that that could be the case. But again, every situation is unique and you need to take a look at it.
You know, it's interesting, Phil, because I think if you're going to do married filing separately, it probably makes sense to run, because this is all software. It makes sense to click the button, make it married filing jointly and figure out which is a lower tax liability. I mean, it's just numbers, right?
Well, and you may have other reasons such as asset spouse or other reasons for filing separately.
Anita says, your next webinar, good to hear about the next session. I hear that question so frequently. I always refer them to our team. So that is great. So we're going to cover that. Phil, thank you very much. Keep watching. If you're watching on YouTube, keep watching because the next webinar is going to come up.
Thank you, Jim. I appreciate you having me.